Hello, everyone. Thank you very much for joining today's webinar, which is focused on becoming financially independent. And I'm going to talk about 5 millionaire habits, which really are the cornerstones of success. I'm joined today by two of my colleagues, Clean O'Donoghue, who's Director of our Business Development, and also Ruth Murray, who is Head of our Marketing Department. And just going to focus on the 5 separate core areas, as you can see, hopefully listed there on the screen. And if anyone would like to ask any questions, please feel free to do so into the Q&A function. We try to make these sessions as interactive as possible. And for anyone who hasn't been on a webinar thus far, really it's a case of trying to impart information, and I hope that there will be some takeaways for you. So just starting out, in relation to managing all types of debt, I'm going to touch on how you can kind of focus on that. Also, a case of saving more and paying less in tax, the FIRE movement, and the millionaire pyramid. My colleague Ruth has just put up a poll which you might answer just while we're waiting for the number of people to settle down, and then I'll get into the thrust of this. Just while we're waiting, just to mention to you, for anyone who hasn't been on a previous webinar and isn't that familiar with Alpha Wealth, we're an independent financial services provider with offices in Cork and Dublin. We have 10 staff, all of which are qualified with over 60 years of combined experience managing over 200 million of assets under management. So just to get into the thrust of it, the first area that I want to talk about is reducing the debt you pay. And sorry, no, I'm just going to navigate this. And really, for all of us, the key aspects of starting a financial plan and to becoming financially successful is making sure that we set out clear financial goals, making sure that we have a financial budget, which I'm going to touch on in a moment, and also then prioritizing what's really important to us and how we can make sure that we're best navigating our financial areas of success. So the first part is the budget calculator. For anyone who's had a financial review with me, or anyone that does book in for a review with Alpha Wealth, this is really the starting point. It's something that we insist upon. It may seem a little bit mundane, but it really is the biggest way in which you can ensure that you're not spending money in the wrong areas, you're reducing costs that most of us bear. And I do think it's something we should absolutely adhere to at least once a year. There are many calculators available online, completely available to download. My colleague is going to put into the chat function a link to Alpha Wealth's budget calculator, which I think is a very good one. It does provide a nice little chart and it'll help you assess. And I think that using this in conjunction with an advisor will assist you going forward. So just to move forward, in terms of the first area that I'd like to touch on today about debt, all of us are in debt to a bank or financial institution at some part of our lives. Generally speaking, if we buy a property and take out a mortgage, but also other forms of debt. And what I'm trying to suggest is that we shouldn't fall into this debt trap. Sometimes we get pulled into advertisements, this whole thing about instant gratification, particularly when it comes to short-term debt. Particularly credit cards, which I'm really not a big fan of. If you're paying interest on a credit card, it's the first area that we help our clients to, I suppose, effectively avoid, but also other ways in which people borrow money for certain things. I'm not totally against people borrowing money. It's just the fact that we focus on the repayment of getting that loan repaid. And I talk about a snowball effect. This effectively is a strategy of paying off the shortest, smallest loan first, which generally tends to be the highest interest cost, and then focusing on the next loan and so on, hence the snowball.
So, Nick, I'm going to stop you there and just jump in with a question that has come in from somebody, just to say that we are a 2-car family and have always had a car loan and probably always will. Is this really a bad thing, or what would you recommend for somebody in this situation?
We're finding people are more often taking out loans for cars, especially with the fact that obviously cars now, particularly if you're getting a hybrid or an electric vehicle, tend to be obviously more and more expensive. In principle, as I said earlier, I'm not totally against car loans. The problem we have is that because interest rates have risen over the last 2 years, the cost of finance now has also risen. And what we're seeing is that car loans are now, on average, somewhere around 8.5% interest. So the first thing I'd always say to people is check what interest rate you're paying for the loan. If it's a very low interest rate loan, if you happen to be fortunate enough that it's 0% finance, fantastic. The problem is, though, if you are paying a car loan which has debt of 8, 9%, or even more interest, that's quite problematic, particularly if you've got money that's in low interest accounts. You're effectively basically borrowing money from yourself and you're losing out on the transaction. So the key thing I'd say is find out what your options are. Do you have available funds to pay off the car loan quicker? If so, that might be a really good way of saving money rather than leaving it in the bank or credit union earning very low interest. And that's really the strategy. The other thing I'd say about car loans is if you adhere to some of the principles of today and build up savings, hopefully the next time that you buy a car, you won't need to borrow as much. And then the next time, less again. And hopefully get into a situation where you're paying for these cars outright through cash that you've accumulated. And by saving effectively, I think that's possible for all of us over time. The next thing then is around savings. And I've touched on this already, but what I say to everybody is you need to compartmentalize your savings into short, medium, and long term. And it's a phrase called save first, spend later. By doing the financial budget, you should have a sense of how much money is coming into the household. You don't have to combine your finances with your partner if it's relevant. But in some instances, it's important for both of you to be focused and say, okay, how much are we earning as a household? What is being spent on certain items? And the fact that we commit money to saving first. If you're earning, say, on the example on the screen, 4,000 a month net, and your aim is to save 1,000 a month because you have financial goals that you want to achieve, and this is where it comes back to the planning piece. The point is save it first. Then the 3,000 left over is for you to do other things with, such as pay into a pension, mortgage, and so on. And that's the strategy really that I think people should take. I know you may think it's easier said than done, but the key thing is that there's no point spending your money and then trying to save what's left over. Typically, that doesn't tend to work very well. And if you start early, the power of compounding interest is really effective. If you're trying to build up money over, to buy a property in the next 5 to 10 years, start now. And by doing so, you don't need to commit as much. And the effect of interest compounding will give you a much better return over that period. And again, on the screen, for those of you that are watching this, you can see that what you try and do is you try and allocate a certain percentage of your salary. I would suggest about 20% towards short and medium term savings. Okay, so I've said earlier, everyone should be saving. All of us should try and put some money away into short-term savings. So as part of this 20%, how much of that are you going to allocate to the next 0 to 3 years? And that's the period of short term. What are you allocating that money for? Are you looking to buy something in the next 3 years of, substance? Are you looking to change your car next year? Are you looking to try and buy a property in the next 2 years? If so, your focus should be on short term. The key message that I'd like to give all of you is that don't accept the 0% deposit rates anymore. I continually talk to people that are still leaving their money in the credit union or in a bank where they're not getting interest. And the reality is that for monthly savings, typically with the likes of AIB and Bank of Ireland, not PTSB, their rates are not quite as good. You can get 3% on an online saver. But you have to watch for the right type of account. For example, Bank of Ireland have a mortgage saver account paying 2% interest, and yet they have an online saver paying 3%. And so it's important to navigate the interest rate you're on and also the terms that you must abide to. For example, if that account exceeds a certain limit, they'll reduce the interest rate on you. So what you do is you just stick to the rules, typically 1,000 to 2,500 per month that allow you. and that you try and then push the money into another account once you reach the limit that those accounts allow.
So for Nick,
Lumps.
for anybody with a lump sum at the moment that wants kind of instant access to it, and it's a short-term kind of savings account, where would you suggest?
I think it's really important for all of us to open our minds to the fact that the banks don't want to see us anymore. They're all moving online. And I'd go a step further and say you need to think beyond Ireland. Pascal Donoghue made reference earlier this week around people putting money into foreign banks. And I'm a great advocate for the fact that as we are part of Europe, putting money into certain institutions, such as a German fintech bank called Trade Republic, will pay you up to 50,000 euros of your money, 4% gross interest with instant access. People often ask me about the security. It's governed under the EU government guarantee scheme, which is stronger than the Irish government guarantee scheme. The fact that some of you may not be familiar with Trade Republic, you should lend yourself to the fact that you just need to educate yourself, taking advice from independent brokers like myself, Googling Trade Republic, and just reinforcing the fact that it should give you that comfort that I'm asking you to take. It's really easy to set up. You do it on your phone, online. You can just transfer euro across if you want to get comfortable with it, transfer it back, make sure the account works well. And I'd argue that it's very similar to Revolut. Most of us use Revolut now, not knowing where it's based, what level of security it provides. It's this kind of herd mentality. And the
So
same is
Nick,
starting to happen.
also just on that, in terms of dirt tax, then it's obviously your 4% less dirt, is it? Or what way does that work? Can you just
It is, sorry.
explain?
So the rates that I've quoted are eligible for dirt tax. Just be careful. There are some accounts, the likes of Bunk. There's others, Lightyear. Many different types of banks are now coming onto the mainstream platform. You just need to be mindful of the tax consideration. Not all of them will be treated in the same way. I am suggesting strongly that Trade Republic is the best of the instant access accounts, but the limit is up to 50,000 euros. But it's a case of navigating the institutions. The next best, in my opinion, would be Raisin Bank, who currently offer 3.65% for term deposits. That's 3 months or more. And you can get access to Swedish AAA rated banks, which are far significantly safer than any of the Irish banks. PTSB, for example, is a treble B rated institution, much less secure than the Swedish bank that I've just referred to. Yet the rates from the Swedish banks, TF Bank, just to mention, they provide twice the interest rate that PTSB will. Just to move on to an illustration. So if you want to know the significance of why this is so important, if you're saving 1,000 euros a month for 3 years, and if you're earning 3% gross interest, that will give you about 37,500 in that period. If you're leaving it in one of the Irish banks, not earning as much interest, and I've used the example of 1%, which a lot of these accounts are providing, you would lose 1,000 euros over that 3-year period. Can you imagine how significant that is, particularly with larger sums, particularly over a longer period of time? We now move on to the medium term, which is your 3 to what I call the years of financial independence. Typically, for most people, I'd like to think 60 years of age. It could be sooner. It might be beyond that. What is the purpose of this type of savings? It's if you want to change a car in 5 years' time. It's if you're saving for children's education needs and you have single digit children in their years, you've got a 10-year plus time frame. You have no business leaving the money in the credit union or post office or the bank. You're not going to get a positive return because inflation is going to be your enemy. By you taking advantage of these types of savings plans, which are available within the insurance companies, the likes of Zurich, Aviva, and so on, you can generate average returns comfortably of 5 to 6% per year, where they're completely accessible. There's no entry costs. There's no exit penalties. And because, again, we're back to the compounding effect of growth over a long period of time, you're going to make significantly more money. If you have a lump sum, you can invest that money again in these types of accounts. You can get tax relief on an investment, which I'm going to touch on in a second. The chart that's on the screen there is probably one of the most powerful takeaways from today, is to understand what it is that you're doing with your money. What type of account are you in? The Trade Republic account that I mentioned falls under risk profile 1, very safe, low interest bearing, albeit it's much more significant than the banks, paying 2.7% net, as I've said. However, if you've got the time, and the time is a key component here, the 3 years plus, you can afford yourself the ability to go up the scale slightly and benefit from much better returns. And anyone who is putting money into a pension, for example, over a 10-year, 20-year period, they can go even higher again and benefit more from that. The third area I want to talk about, and again, please do feel free to put any questions into the Q&A. We have received some questions over the last few weeks, which my colleague Cleena is going to address as we go through this. But with regards to tax, tax is one of the biggest payments we make in our lifetimes. It's one of the biggest costs. 3 things you can do to reduce the tax you pay. One of them is to put money into your pension. The second is to invest in a government scheme called the Employment Investment Incentive Scheme. This is particularly relevant for higher tax rate payers. The third is for anyone who has children or may have children in the future. We have a very penal tax system in Ireland, but you're still allowed to give up to 6,000 a year to your children tax-free. And it's definitely something that I would suggest that parents do consider, but you need to allow time, obviously, to provide yourself the opportunity to make sure that the taxman's not taking more of the money that you want to go, obviously, to your kids. I'm going to talk about pensions now. And pensions, generally, in my opinion, are very much a misunderstood product. For anyone who is paid more than 42,000 a year, and the average wage in Ireland is about 46,000, you can put money into a pension, which is really just a long-term savings account. And the government will give you 40% of a reduction on that payment. You put in 100 euros, it costs you 60. You put in 1,000, it costs you 600. And the example I give you is that it's really like what I call a 66% boost. And the reason I'm saying 66% and not 40% is that if you think about it, if you put in 60 euros and the government turned that into 100, if you get a calculator and put 60 times 1.66, that's 100. That's the boost. It's what you actually gain on entry. And that's why it's so significant. The other advantage of pensions is that they grow tax-free. There's no other savings account you can do where the taxman's not going to penalize you either yearly or every 8 years in any form of investment, but they will live you off for the pension throughout the full duration. So if you're in your 20s, 30s, or 40s, you're going to benefit from 10 plus years of the taxman not touching your money. And then finally, I'm back to the compounding growth. The concept that Einstein said is the 8th most powerful force in the universe. You really need to consider that your money that's growing and snowballing year after year is going to give you that millionaire habit that I spoke about earlier.
So Nick, before you move on, we have a couple of questions that have come in. So the first one is, my company doesn't have a pension scheme. With auto-enrollment being imminent now, how is that going to affect me and them?
So for anyone that's not aware, auto-enrollment is basically the government provision that they're going to force employers to pay 1.5% of all employees' salaries into their pension, subject to them earning over 20,000 a year and being between the ages of 23 and 60. So for anyone who is working for a company that doesn't provide a pension scheme, there's at least some good news coming later on this year. The government have said that it's likely going to start in September. It could be deferred until December, but they're insisting that it will happen this year. And I am speaking to employers about getting ahead of the game and being proactive. I'm not a big fan of auto-enrollment, even though it may sound great for an employee that doesn't have a pension scheme through work. The problem I have with auto-enrollment is that basically you have no flexibility, you have no choices to make, you cannot choose which provider, and unfortunately you get no advice with it, and you cannot draw the pension down before the state pension age of 66, which, as I've said earlier, personally I'm not really that keen on, because I'd like to think that most of the people on this call today, if they're adhering to some of the things I'm saying, should be in a position where they could retire a lot sooner than that.
So Nick, sorry, there's more questions. So do you mind kind of dealing with them now?
No, no,
If you're
please go
looking
ahead.
at long-term investment, IMO AVCs to your pension guarantees a 66% gain plus or minus, then future tax sheltered growth. Any comment on that?
That's what I've just described, the
Yeah.
66% growth and the tax-free growth, absolutely. If you're
Yeah.
working for a public service, which the IMO obviously would refer to, you should be making AVC payments. The key thing is you don't have to do them through the IMO. You can choose which provider. And just to touch on, one of the things is not all pensions are the same. The two big components I say to everybody, if you have a pension scheme, is do you know what fees you're paying? Because you shouldn't suffer fees. We offer in Alpha Wealth very competitive fees where 100% of your money is invested in the pension scheme. If you want to do yourself just one thing today and just find out the fees you're paying on your pension, if it's less than 100%, you're paying too much and you need to look at alternatives. The other key thing about pensions is there are so many different funds available and so many different types of pensions. It's really important to make sure that you're at least understanding what options you have. If you're in a company pension arrangement and your company has chosen Irish Life as the provider, you can't pick a different provider, but you can pick the fund that they invest your money in. And as I mentioned earlier, if you're relatively young, 20s, 30s, maybe even 40s, I'm 50 myself, it allows you the opportunity to take a bit of risk. If you're coming towards your later years, obviously you may want to be slightly more selective. Doesn't mean that you shouldn't take any risk at all. I speak to clients about what they should try and build up in their pension fund. And again, as a high level kind of aim, I'd say 400,000 is the minimum amount that you should look to achieve. And the reason I use 400,000 is that if you were 60 today with 400,000 in your pension fund, you should be able to retire reasonably comfortably. What that would allow you is 100,000 of that 25% tax free. The 300,000 would generate about 25,000 a year of an income. May not seem like a lot, but you've got the ability to draw on this 100,000 until the state pension kicks in, which is 66. That's another 14,000 a year, bringing you roughly to about 40 grand a year. You don't pay any tax at the higher rate. That's not bad at a starting level. Obviously, the aim would be trying to build up your pension over and above that. And this is where the planning piece comes in.
So another question, I was saving into a Zurich PRSA and now my employer is contributing towards a pension with Irish Life. Should I add that to the Irish Life pension or transfer it to you guys?
It depends. You need to get someone to review it for you, but it depends on the fees, like which of the two schemes provides for a higher fee. That's the one that I'd be looking to transfer away from. In terms of the two schemes, do you have a projection? For all of the clients in Alpha Wealth, we always provide a projection based on the age in which they'd like to think that they've become financially independent. We asked on the poll earlier about when do you think you could retire by? As it happens, most people said state pension age. I hope, again, by listening to today's webinar and perhaps talking to us in Alpha Wealth, we can bring that age down for you. And I do feel very serious and focused about doing that for clients, setting out this goalpost. You know, we talk about what is required. Interestingly, and again, I'm going to talk next month around a concept that I'm going to touch on today called FIRE. If you start your pension, even at a moderate level, you'll be surprised by how quickly it grows and that you don't need as much as you might think. I've just described the figure of 400,000. For a lot of you, particularly if you have a pension scheme at work, you're probably on target to reach that by 60. And we can show you how, again, it'll help you in terms of reaching a position where you can either work less hours, do something that you maybe enjoy, retire completely if you so choose. But we talk about this phased approach to retirement rather than this just dead end stop when you reach 66. I'm just going to touch on the tax scheme that I mentioned. This is the complement to pensions, and it's really relevant for people who have, say, rental income. You can't use a pension to offset the tax you pay on your rental property. You can for this tax scheme. For anyone who wants to benefit from getting money back from the government, but doesn't want to wait until they reach pension age. And by the way, company pensions are available from age 50 onwards. So it's not that you have to wait until you're 60 or 66 to benefit from your pension scheme. And this is where advice is really important. But this tax scheme called the Employment Investment Incentive Scheme is something that we've been involved with for a number of years. And just to give you a quick example, if you had 10,000 euros in the bank that you could do without for the next 4 to 5 years, you can invest it in one of the 70 or so Irish companies that are rubber stamped for this scheme and get 3,500 back from the government. There are a lot of different types of companies. You have to be very discursive about the company that you invest in. And Alpha Wealth's role is to find the best ones out there. One of them I just want to mention is a company based in Cork. It's in the hospitality industry, which may possibly put some people off. But when you look at the company that's behind it, the company's called Clistra. They own 12 hotels up and down the country, including the Muckross Park in Kerry, a number of Radissons, and they've done extremely well and successfully over the last number of years. They recently bought and renovated the viaduct, for anyone who's familiar, on the way out to Bandon from Bishopstown. And they're doing something very similar in the Middleton area. Middleton is massively overpopulated for the number of restaurants that service it. And there's a huge opportunity, they feel, to provide a really high-end bar, restaurant, bistro with a rotisserie. And I do think that it's a really good opportunity for people to make an investment, get their 35% tax relief, and benefit from the interest that Clistra will pay them over that 4 to 5 year period when
So
they
Nick, for
return their
anyone
monies.
that's looking to invest money, like would you recommend something like EIS, or should somebody invest in crypto ETFs? Because that's come in as a question.
You need someone to review your situation, because obviously it depends on these different parts as I've described and the balance between the short, medium, long term. There's no point me suggesting you put money into EIS if your objective is to buy a house next year and you need the funds to do so. I'm not a big fan of people buying crypto. It's very speculative. It's very high risk. The tax treatment on an ETF tends to be 41%. So it wouldn't typically be sensible to do it in that vehicle. But if you have 10,000 in the bank and you want to invest 1,000 in crypto as your speculative investment, I'd allow that. But if you're going to put 10,000 of your 10,000 investable cash in crypto, that makes no sense at all, particularly knowing that there are other schemes like your pension where you can expose yourself to that type of investment and allow yourself the, I suppose, risk, having taken the tax relief, or indeed other options like EIS that perhaps you should consider.
And Nick, on EIS, can you just explain what the minimum investment is with 5 Mile and what is the projected 4 or 5 year return?
5,000 euros is the minimum. The projected return is 30% cap. So if you put in 5,000, 5 Mile will pay you a maximum of 6,500 back. The company's projections are significantly higher than that. But obviously, from your perspective, you're getting your full 35% tax relief from the government, and you're also getting potentially up to the 30% from 5 Mile. In my opinion, that's a really good opportunity for people who can afford to not need the money for the next 4 to 5 years and are high rate taxpayers. Just to touch on those people who have children, or if you have children in the future, two really big takeaways. If you have wealth accumulated, and many of us are not going to spend our pension pots as much as we might believe we will. As I said earlier, your money in your pension accumulates post-retirement. The 300,000 on the example of 400 I gave earlier, it still continues to grow and earn interest. And most of us are really just drawing the interest earned rather than the actual capital from it. You're only allowed to gift, or your children can inherit, up to 335,000 per child. That means that if you've got, say, 3 children, that's €1,000,000. May seem like a lot of money, but that includes your home. If your home is worth 500,000, the kids will have to sell the home in order for them not to pay tax. If you've got other assets, including pensions, investments, and other property, there is no way they can avoid paying tax on the money that you leave them. What can you do about it? Well, you can start to put money into their names, not necessarily giving it to them. And if they're under 18, obviously you're not going to. but you can build money up very effectively in savings accounts, such as the ones I've described earlier, and allow them to use the money for third level education needs and so on, but it's not seen as part of a gift. Many parents find it necessary to buy their 18 to 20-year-olds a car to help them get around, and they buy a car for 20 grand. Based on that, you're only allowed to give them up to 6,000 a year. Outside of that 335 threshold, 14,000 of that will be deducted from the 335. If you had the ability to put that money every year over a 2 to 3 year period away for them into an account, then none of that would be reduced from the 335 threshold. The second relief is called Section 73. This is really relevant to those people who have excess funds, particularly if you're drawing your pension fund, and you can invest monies in your name in several insurance companies and benefit from the fact that if you do it over a period of 8 years or more, all of the money that accumulates in that account can be used to help your kids pay tax on the monies that you leave them. I appreciate that, again, this may not be something that people are really thinking about firmly today, but it is important. And one of the biggest takeaways I'd like to give you today is that any form of reducing tax is around planning, and it takes time. And typically you need money to do it. Putting money into a pension costs you money. Putting money into EIS costs you money. Putting money away for your kids costs you money. You might think, well, we're more interested in ourselves at this point in time. Maybe so, but again, as part of this overall financial plan, you may find yourself in a position where you are saving for kids' education. You're just not necessarily saving in the best way possible, perhaps putting it into their names rather than accumulating the wealth in
And Nick,
yours.
sorry, I'm going to ask you another question that came in earlier. Am I allowed to access my kids' funds in their under 18 credit union account and put it into the Zurich savings account?
You can. What you're doing is you're basically taking it out of the credit union and popping it back into Zurich, but through their names. Again, I can talk to you directly on that if you want to pop me an email, and I'll explain how that works. The difference between the credit union and Zurich, guys, is that the credit union pay you very little interest. You're going to lose to inflation year after year. The Zurich account, in my opinion, will exceed inflation over a 3-year plus period. Just in terms of property, people in Ireland like property ownership. However, it's not particularly tax efficient. How can you avoid the tax you pay on a property? By putting it into a pension fund. You accumulate a pension fund of 200,000 plus. If you've, say, worked for a company and your company pension is worth 200,000, you leave that company, you can use the 200,000 to buy an apartment. Why would you do that? Firstly, because it produces an income. Secondly, that the rental income you receive and any growth in the value of that property are tax-free. Certainly something for people to be aware of. And our role in Alpha Wealth is obviously to explain the pros and cons of those types of decisions. And I do think it's important to get appropriate advice if you are looking to consider that. The fourth area of today is around FIRE. What is FIRE? FIRE stands for Financial Independence Retire Early. This is gaining huge traction, particularly online. It dates back to over 30 years ago, where basically it's around people who want to aggressively save in their younger years to be in a position where they can effectively stop working by the time they reach 40 or 45 years of age. I think it's too aggressive. However, I think that there's some really good learnings in that. It's really about focus. It's about making sacrifices, maybe too much. Traditional FIRE really refers to saving up to 70% of your income. What I would suggest, though, and why I'm doing a webinar on it next month on the 14th of March, which I'm going to talk about in a second, there are different forms of FIRE. For example, I'm a 50-year-old and I'm going through what I describe as semi-FIRE, where I'm working hard, earning money, but also spending money, and I'm enjoying my life now while I feel I can afford to, from a point of view of, travel and physically and so on. However, there are different forms. Even people on moderate incomes can retire early. It's just about them understanding around reducing the tax they pay, trying to avoid unnecessary debt, and also obviously focusing on making provisions, primarily in their pensions. And
Nick, sorry, I'm going to ask you just to look at the results that you took from the poll, which I'm going to share there now on the screen. So when you look at the age profile of people, the majority of people on the webinar today, which would be 46%, say that they're hoping to retire by 60, 31% by state pension age 66, and only 8% at 50. So what advice would you give on this?
I don't want to sound coy, but I'd have a financial review and see exactly what age it would look like. And this is something that we can do with you, and setting out these projections, as I've mentioned to you, these goalposts, as I refer, not just for your pension, but also for other assets you have, including other goals, such as, like I talk about this goalpost, you know, as I said, as a 50-year-old, my particular one, and I'm in a blended family. I'm focused to age 60, and I have a very specific goal in mind. It varies for different individuals, but the key point is that you review your situation annually. We don't charge for annual reviews in Alpha Wealth, and we provide this independent guidance to help you in all areas, including mortgages, health insurance. Most of my clients pay too much for health insurance, and we help them understand what they can do by taking advantage of discounts, by making sure that they're getting offers, particularly if they've got more than one child, where they only pay for one of them and get very good benefits for them. And there's a whole myriad of areas that we can improve our financial position. The final area today is on what I call the millionaire pyramid. This is really bringing everything I've said earlier together. The focus piece, making sure that you try and adhere to principles of what you are trying to save towards, not overthinking things and not procrastinating about starting a pension or starting savings. My thing is to say to people, we all benefited from changes the government made back in October in the budget, where we all benefited by roughly about €100 in our monthly pay packet in January, but most of us did nothing about it. And if we were being a little bit forward thinking, we'd say, okay, well, we're now better off €100 we probably didn't absolutely need. We can now apply that to maybe savings. It's embracing that 80-20 rule. You know, it works in most areas of life, including finance. Most of us are really, you know, basically spending 80% of the time for 20% of our results, and it's about turning that around on its head. And where it's worthwhile talking to a financial broker is helping you and possibly a partner understand what financial position you're in and how to make the most out of the money you have. And we've touched on quite a few areas today that we can explore and go through with you. Just in relation to, I suppose, the last thing which I want to talk about, and sorry, I'm just getting on the slide, is book a financial consultation. We charge a once-off fee of €199. There are no further fees or charges that you bear. And this provides this full review of exactly where you are now, providing you these financial projections, giving you independent advice and guidance on all of the areas I've talked about today, including helping you navigate mortgages, to ensuring that you're not paying too much for insurances, to making sure your pension is working as hard as possible. My colleague Ruth is going to put up into the chat function the link to the next webinar that I'm doing, which is Thursday, the 14th of March, specifically around FIRE, this whole thing about how can you retire early successfully. My colleague David Looney is doing a webinar on redundancy. If you or anyone that you know has the prospect of possibly being made redundant, and we're seeing more and more people, unfortunately, that are hearing that they could be made redundant, it is a webinar that I'd absolutely encourage you to access. And you can get access to all of our webinars, also some of the ones that we've done previously. I did one recently on auto-enrollment, which is up on our website, and you can access these completely free. I'm just going to open the floor up if anyone does want to ask any final questions. Thank you so much again for your input. And my email address is there on the screen. You can obviously follow us on social media. Certainly, please do, because there's a lot of takeaways that we're, trying to provide people. And obviously our website, which gives you a lot more insight, particularly into some of the webinars that we have coming up.